Following the U.S. election, we saw massive rallies in U.S. stocks and the U.S. dollar on anticipation that President Trump would come in, bring in sweeping pro-business reforms, and drive the U.S. economy. It now appears, however, that this Trump trade is starting to unravel. We're seeing the U.S. dollar start to top out. We're also seeing stocks start to top out. The peak for stocks came on the 1st of March. We saw a number of factors come together to drive the stock market. Not only did we have the U.S. election, freed up a lot of pent-up capital that had been on the sidelines, then the rally kind of took on a life of its own as we got into year-end and then into retirement savings season. Now that that's all out of the way, we're kind of starting to head into a seasonal peak and even possibly a seasonal correction period for the market. At the same time, we're seeing that a real shift between expectations from the campaign trail and the realities of governing are also starting to weigh on the markets and catch up to the rally. President Trump made a lot of promises, but what we've been finding as he's moved into government is that it's not as easy to get things through Congress, even when your party actually controls it. We've seen that difficulties with health care. We could see the potential for difficulties with tax reform that could delay things, with infrastructure spending that could cause delays as well. And that's the street's starting to realize that the speed of government and the speed of markets are two completely different things. And because of this, we may be starting to get into a correction. On top of this, there's external distractions as well with foreign affairs, with not just in terms of trade negotiations, but also in terms of political tensions with North Korea, with Syria, with Russia, with China, and a number of other countries. The other thing we're seeing is that monetary policy and fiscal policy are starting to get rethought as well. We've seen on the campaign trail, President Trump complained about the Fed artificially depressing the U.S. dollar to help the Democrats, and he was going to sack Fed Chair Yellen and demand that they start raising interest rates up to where they should be. And now we're seeing President coming out and saying, the U.S. dollar he thinks is too high, that interest rates that he would actually prefer to see lower interest rates, and he even hasn't ruled out keeping Fed Chair Yellen around after he'd already promised to sack her. So, clearly there's a lot of shifts and changes going on. We're seeing that start to play out in the markets, and most importantly, we're seeing that this election honeymoon rally is starting to get exhausted, and things are starting to roll over. We're now moving into earnings season. This is important because when the big rally in stock markets has driven up expectations, has driven up valuations. So two things need to happen. One, will companies be able to deliver enough earnings or guidance to keep the street happy? And the second thing is, are traders exhausted? Are they still willing to take on new positions, or are they looking for an excuse to get out, whether to get mad and dump companies that disappoint, or just to take profits against the news? That's what we're going to be seeing over the next coming couple of weeks. So I'm just going to show a few charts here. We'll start off with the US 30. The Dow, and we can see here it had a really strong run between election night in November and the 1st of March. It's quite interesting. This 1st of March peak here pretty much coincides with deadlines for retirement savings and tax breaks related to putting money into retirement accounts. All the deadlines for the US, Canada, the UK, and a number of other countries are all in and around the 1st of March, either a little bit sooner or a little bit after. Since then, we've seen with this big, huge influx of demand for stocks kind of tapering off, we're seeing the market's actually been coming back the other way. It's gone into a falling channel here. We've seen it break under its 50-day moving average, and that now starting to become resistance. We've got the Dow trading from 130 its peak, back under 21, back towards 20,600. This 23% Fibonacci retracement here is about 23,270, and then there's the 20,000 round number. Also note, we had a double top in the RSI. The RSI is broken under 50, and it's staying under 50. This is indicative of distribution. This is indicative that momentum is starting to turn downward in the Dow. If we also look now at the S&P 500, we've seen a bearish technical failure here too. Not only did we have it got extremely overbought, and the same thing trending lower and rolling under 50, but more importantly, we've seen in the past where we had rally consolidation. Well, this time around, it looked like we were getting consolidation again with this nice symmetrical triangle forming. It's now failed. We've now seen upward trend support starting to fail and becoming resistance, so we're seeing some weakness in the S&P kick in as well. We're just under 23.50 right now. First support about 23.35, and then down here this 23% retracement in and around 23.12 or so. We're also seeing this with the U.S. dollar. The U.S. dollar, it had a massive rally. We've seen it peak here in early March, and it rolled down. But more importantly, look at this. This is a classic evening star pattern here. A big update, a move to a new high, knocked back a little bit, and then we start to see it break down, and then we see it really break down again. Here we're just getting an inside day where we're pausing, and the RSI is leveling off around 50. But this evening star candle, bearish for the U.S. dollar. And we're also seeing that play out in the price of gold, where gold moves in the opposite direction of the U.S. dollar most of the time. So when the U.S. dollar exploded upward, gold crashed in November and December. But gold, look at this, bottomed out in kind of mid-December. And since then, gold has been trending upward. The U.S. dollar has been trending downward. This is a number of factors impacting gold. One is the complacency that had set in has been getting whittled away and whittled away. Political risk is coming back. Financial monetary risk coming back. Not only do we have the headline Syria, North Korea, the French election is coming up. There's uncertainty about what happens with trade policy, what happens with general politics in the U.S. Will the president be able to get anything through Congress is becoming more of a question now, whereas before it was considered to be a slam dunk. So we've got gold trending higher, we've got the U.S. dollar trending lower, and stocks starting to trend lower as well. As we move into earnings season, we're going to be watching how do markets react to news. And so we're going to start today with JP Morgan Chase, one of the first big name stocks. They came in, they beat the street by a big margin, really positive earnings report. But we can see here, relative to previous moves of the stock and even relative to recent action, the move's pretty feeble. Yes, we've picked up a little bit in JP Morgan Chase, but not huge. RSI is still under 50, and we're just kind of sitting here in and around the $85, $86 level. We're still below the 50-day moving average. We're still below $90. We're still below the peak up here closer than 94. This first support here is in and around 83.30. And we can see the huge move we've had up. So what does that tell us? This huge move after November has already priced in pretty substantial earnings growth for a lot of U.S. stocks. They're going to have to really deliver. In this case, they've delivered enough to have a bit of interest come in, but at the same time, not enough to really explode upward. The markets are starting to look pretty pricey here, pretty fully valued, and I think that's what the action here is telling us. It also suggests that companies who disappoint could be really punished severely this time around, and that could be on earnings, it could be on guidance, because we've only had a couple of months of President Trump in the quarter. But what's going to be most important is looking forward, particularly as we get into the industrials and the infrastructure stocks that we're expected to benefit from wall building and other infrastructure projects. For the coming week, the one to really keep an eye on here is Netflix. Netflix is has been one of the premier momentum growth stocks the market has really come behind in recent years, Netflix's and Tesla's and a few others. And what's interesting with this is, had a massive rally. It actually took off in October before the election on an earnings report, and had a bit of a correction, but it's been trending upwards since. Back in January, it gapped upward on a strong earnings report, but we've seen upward momentum starting to flatten out lately over February and March. Even though the uptrend is still intact, we're kind of have come back to this 50-day moving average here. This is around 143. The 200-day average is down below 120 at about 119.10, and we're seeing slowly but surely lower highs and a growing divergence, because we've got higher highs still in higher lows in the share price, but we've got lower highs in the RSI, and this is indicative of slowing upward momentum. And that's really important, because if we are seeing upward momentum start to slow, it means Netflix really has to deliver. And if it doesn't deliver, this stock could tumble. So we want to keep an eye on that. And if it does deliver strong reports, well, we had a big gap back here. We had 2 quarters ago. We had a smaller gap last quarter. Do we get a gap up if we get a good report? Do we really take off to the upside, blast through this resistance here at 148 or 150? Or do we just kind of stabilize or go up a little bit, a feeble amount like we saw in JP Morgan? That's really important, and the Netflix report in particular could be really telling about how markets are prepared to react to earnings reports. Are people looking for an excuse to pile in and go for more, or are they looking for an excuse to get out and take profits? That's what remains to be seen. So as we see the Trump trade start to unravel, the response to earnings reports could be particularly volatile this quarter.